Hey everybody, back with another video, and today we're going to be talking about the recent interest rate increases, what a rising interest rate environment looks like, some takeaways from that, and some vehicles you can use for your money in a rising interest rate environment. Without further ado, let's get on into it. First of all, some things about yesterday and the rising interest rates from Bankrate. Decent website, pretty unbiased, just a bunch of information. Now, there was a 75 basis point or 0.75% increase, which was more than what was expected until a week ago. We can see that the Fed thinks that they're going to try and keep the Fed funds rate at about 3.25 to 3.5% by the end of the year. I think it's going to be higher than that because inflation shows no signs of stopping. So I would think that would go probably up over 4%. They're saying that they see inflation at 5% by the end of 22. That's probably a best case scenario. That's possible if they do get ahead by raising interest rates a lot. But if they keep doing what they're doing now with just half rate increases, it's still going to be well north of 5%. They see joblessness rising to 3.7%. Again, I see that going much higher. A lot of these tech industry jobs, these do-nothing jobs, are going to not exist anymore once all those companies start going bankrupt because they can't make those payments. So, what are you going to do with your money in a rising interest rate environment? What can you do? There are some things you should look at and some things to stay away from. Of course, starting with the things to stay away from, this is going to be most equities and most bonds. When interest rates rise, that means that companies will have to pay more on their debt, which means they're going to have less money as cash flow. They're going to have to use their income to pay debt, which is going to drive down their value, things like that. Equities are going to suffer a lot in this. Aside from that, most bonds are going to drop in price because bond prices move inversely to rates. As rates go up, the bonds fall in price to match with future past bonds getting to be about the same where their rate is. That's a little bit more complicated. Just know the basis is that as rates go up, bond prices fall. If you want to know more about that, just ask me in the Discord. I'll be happy to go over it in more detail. But what are some things that you can do with your money so that you can make a little money, try to take advantage of these rising interest rate environments? We'll go over a few here, starting with the simplest and safest to the ones that are a little bit more complicated and carry a little bit more risk. The simplest one to start with is a simple online high-yield savings account. A lot of people, a lot of younger people find this to be completely boring and useless. I mean, who cares if you're only getting 1% when you can make, moonshots in the stock market? But when you're in an environment like this where you could lose everything in a day, you could have 5% swings down 3 or 4 times a week, the old adage of just putting it away and letting it earn interest seems to be working. Now, interest rates on savings accounts prior to a couple months ago were abysmally low, with even high yield savings accounts yielding at most about 0.5%. But as we can see now, a lot of high yield online savings accounts are getting close to about 1%. We see Capital One here at 0.9%, SoFi at 1.25%. Now, as the Fed funds rate goes up, these are going to keep going up. If I had to make a guess, I would say that by the end of the summer, you're going to be looking at a lot of these being close to or at 2%, and by the end of the year, probably close to or at, or maybe even above 3%. Now, that doesn't sound like a lot, and a lot of people are going to say that's boring, but if you have, just cash laying around, if you've got $100, $200, $250,000 laying around, that's going to be thousands of dollars per year for you in interest. The great thing about savings accounts is they are insured up to the federal limit, which at my last check was $250,000. So if you have $250,000 or less and your bank fails, you get that money paid back to you in an insurance claim. So it is essentially the safest investment that you can make. Of course, there are the downsides. The rates aren't amazing. You can get 1% here. There are, of course, dividends that pay 5, 10, 15%. Bonds will pay more than this. But again, it is incredibly safe. If you just have money sitting around with nothing to do, if you've maxed out your I-bond purchases, you don't want to look at equities, you don't want to look at bonds or anything, you just want to have the money there, then this is something for you. Of course, it's also incredibly liquid. If you just want to take your money out, it's as simple as going to your bank account or your bank, if there's a physical branch, and saying, give me money from this account. It's It's insured, it's liquid, it's very simple. If you just want to make a little bit of interest, more than just having your money sitting around doing nothing, this is for you. Now, moving on from savings accounts is CDs, that is certificates of deposit, which are again an insured, relatively simple vehicle. A CD is essentially just a timed loan to a bank. I'm going to use Capital One here as an example, but most others are going to look very similar to this. We can see that for 1 year, 1.5%, 2 years about 2%, 5 years about 2.5%. Essentially, all you're doing here is you're loaning the money, for example, to the bank for 5 years, and for each of those years, you're going to get 2.6% back in interest. The only real difference between a CD and a savings account is that you are locked in for that amount of time. Again, they are, as you can see here, FDIC insured. The limit again, I believe, is $250,000, but always check that for yourself to be sure. The only difference, of course, being that that time being locked in. Most CDs will let you surrender the CD early, or I should say cash the CD early, but you have to surrender a certain amount of interest depending on the bank, depending on the time frame. It's usually between 60 and 180 days worth of interest you'd have to give up. So for example, if you wanted to cash a 5-year CD at 3.5 years, you're probably going to be giving up somewhere between 2 months to about half a year's worth of interest, which depending on your situation might be worth it or not. Another downside of CDs is that rate there. For example, this 5-year rate at 2.6%, that's going to be locked in. So if rates go up, so let's say you purchase a CD this year, but next year the 5-year CD rate at your bank is 4%, you'll have missed out on 1.4% worth of interest over those 4 years, which could be a big deal for you depending on how much money you have. But again, these are very safe investments. They are insured. This is a lot of retirees will use things like this because they can't risk risking their money. They need something that's insured, something that's safe. There are also short-term CDs. Maybe you just want to lock your money up for a year. Some places go even lower than that, 9 months. That might be something to look at if, again, you can't risk equities or bonds, but you do want to get a little bit more than a savings account for some amount of time. This might be something for you. Next thing we're going to look at is government treasuries. Now, this is where we're getting into risk. There are two sides of investing in treasuries, bonds in general, that is buying the particular bond itself or buying them in an ETF. We will talk about the ETFs first because that's what most people know how to do. For example, here we have TLT, which is the iShares 20-year Treasury ETF, and IEI, which is the 3 to 7 year Treasury ETF. The only difference here being that one invests in treasuries with 20 years left in duration at least, and the other at 3 to 7. Currently, I would be staying away from Treasury ETFs because Treasuries are going to keep going down in price as the yields rise. But if you think you're getting to the end of that rate-raising cycle, Treasury ETFs might be something to look at, as even if they stay stable, you're still going to be getting that yield. Currently, the yields are very paltry, but these will start to go up very soon as certain treasuries start to age out of these ETFs and the newer ones with higher yields start to age in. Now, when it comes to actually buying individual treasuries, it gets a little bit more complicated. If you have to have a Treasury Direct account, if you want to buy them as they're released, I should say. If you want to just buy and hold treasuries for, until they mature, they come in durations anywhere from 30 days up to 30 years. You get a Treasury Direct account. It's very simple. You wait for a Treasury auction to happen, say how much you want to buy, and you will be issued the bonds at their price with the interest rate. I should say be issued the bonds in whatever amount you want at the interest rate that is calculated for the auction. Now, it gets a little bit more complicated than that. Again, that would take, an hour video to go over. But if you want to know more about it, just ask me in the Discord. I'll be happy to go over it or to give you links to things that explain it better. The other thing to do is that you can buy them on the secondary market. I would heavily advise against doing so unless you have been studying how to purchase and trade bonds, as it gets very complicated and you can lose a lot of money very quickly if you don't know what you're doing. But for most people, it's going to be buying Treasury ETFs. Again, these are a little bit more risky in that there's interest rate risk involved if you don't plan on holding those bonds until maturity. Whereas if you hold them to maturity, if you say, I'm going to loan the government $100,000 for 2 years, I'm going to leave it there for 2 years, there is no risk really. The bonds are insured by the government. The only way that you're going to lose your principal is if, the government defaults on its debt or ceases to exist, in which case your money is going to be worthless anyway, and you're going to be caring more about where you're going to get beans for the next night. Our last thing will be corporate bonds. These are they're more speculative than government bonds, and they tend to be a lot more wishy-washy in what's going to happen with them. Again, this is something that I wouldn't be looking at currently, but when you think that we've hit the top of this rate-raising cycle, this might be something to look at. Now, there are two kinds of corporate bonds. There's investment grade, which is essentially good quality credit bonds, and below investment grade or junk bonds, which is poor quality credit bonds. We'll just be talking about investment here today. But again, any questions, just ask me. Now, for pretty much every investor, you're only going to be looking at corporate bonds through an ETF. There are some that you can buy on the open market. There aren't that many, only a couple hundred that the average investor can look at, which you can do if you want. But again, something that you really shouldn't be doing unless you understand how to trade bonds. Now, corporate bonds, as opposed to treasuries, they are not insured usually, and because of this, they generally command a higher yield, as we can see here, 4.3% on this ETF. Corporate bonds, they do run the risk of defaulting, whereas the government bonds very unlikely to default. But this will vary depending on the company that you have the bonds from. If you're in an ETF, it's very likely there are hundreds, possibly thousands of companies. So even if 1, 2, or 5 of those companies default, which is very unlikely in an investment grade ETF, you're not going to be losing much because there's so many other companies in there to cover that. But again, this, along with treasuries, while these are income vehicles that you can look at in a rising rate environment, if you don't plan on buying them on the secondary market, which again, you need to know what you're doing if you're doing so, and holding them until maturity, I really wouldn't be looking at bonds, at least probably until the end of the year, to see if there is a signal that the interest rate increases are going to stop. I would be sticking towards, savings accounts, CDs, things of that nature, or just buying treasuries that you want to hold till maturity. Now, one other thing with bonds, similar to CDs, where if you buy at, if you buy a 5-year at one point and then the rate rises, the same thing happens with bonds. For example, I'll give you something I did somewhat stupidly, but also just to test something. I bought a very small 3-month treasury bill a couple months ago when they were only paying 0.8%, and as we can see, the rate has doubled to almost 1.6%. So if I had simply waited about a month and a half, I would have doubled the interest I was making. Granted, that would have only doubled my interest from 22 cents to 44 cents, but that is something that you need to think about if you're thinking about purchasing a long duration debt of any kind, or a long duration deposit of any kind. There is that chance that interest rates are going to go up by a lot. As we can see down here with our yield curve shown in percentages, we're seeing everything from 2 to 30-year notes being between 3.2 and 3.5% APY. This could change drastically over the next year or two. We could go back to 2005, 2006 numbers where these are all paying 5%. In which case, if you bought a 30-year bond at 3.5%, when you could have bought it a year or two later at 5%, that is at the very least going to make you feel bad, if not hurt your earning power over the next 30 years. There are questions of whether we're going to go back to the 1970s, 1980s, where we had bonds paying upwards of 17 or 18% and savings accounts paying upwards of 14 and 15%. I don't think we're going to get there. I do think that the Fed fund rate is going to get a lot higher than people think. I do think that 8 to 10% is not out of the question. I don't see it as hugely likely, but I see it as very possible. I would expect the Fed funds rate to get to 4 or 5% very easily. That's very likely going to happen. If it gets higher than that, it wouldn't surprise me. I'm not going to say it's going to happen, but if it happened, I'm I'm not going to be out there in the streets with everyone else going, oh my God, I can't believe mortgages are this expensive. I can't believe I can't afford to buy a car, all that stuff. It won't surprise me at all. So yeah, if you've just got money sitting around, you really don't want to get invested into equities at all. You just kind of want to look for more safer things. Look at your savings accounts, look at your CDs, think about buying, treasuries and just holding them for duration, particularly short-term ones. You can go a month to a year. You're still getting a better rate than a savings account most of the time, and CDs. You can just hold it for a little bit. Take it when it comes out, reinvest it. Maybe equities will be affordable by then. But yeah, if you've just got money sitting around, these might be things to look at. Just do your research, ask questions if you have them in the Discord. If I don't answer them, someone will. But yeah, as always, thanks for watching, and I will see you next time.